This has to do with any loans that you might have that are outstanding right now. And what I was curious about is that with the 100 basis points cut that you've seen in the policy rate, that is based on what the RBI has done, the Reserve Bank of India with its monetary policy, has that trickled through to you? And should you be prepaying your loans when your loans have gotten cheaper? Abhishek Kumar, who's the founder and he's a founder of SahajMoney as well as SEBI registered investment advisor. Abhishek, thanks so much for taking the time, and pleasure having you on the program. So the first question is, how do you treat different types of loans? Because they can't all be treated the same. And here I'm talking about home loans, I'm talking about car loans, your white good loans, which are usually swiped with your credit card, and credit card debt.
First of all, thanks for having me, Alex, in this show, and I look forward to talking on this. So as you rightly said, not all loans are equal, and depending upon the kind of loan type it is, whether it's a secured loan or an unsecured loan, the interest rate differs primarily because the risk of default also is different on different kind of loans. An additional factor is that when a loan is tied up to a depreciating asset like that of a car as such, it's also on the higher side because there is a depreciation of assets which impacts the overall interest that the particular asset would come on. So in that case, comparatively, credit card and white good loans are high interest rate loans, followed by education and auto loan. Finally, home loans are comparatively low interest rate loan, and that is what the kind of ladder structure which in terms of the loan rate of interest are currently aligned. So we will always suggest to focus on paying high interest loan first, particularly credit card loans, as you know that they often charge, I mean, more than 20% or more, as this saves a lot of money over a period of time. And when it comes to low interest rate loans like mortgages or education loan, with rates around 8%, you can maintain minimum payments and still invest the balance surplus elsewhere to generate better returns. Compared to that, auto loans and white good loans fall in somewhere in the middle of it and should be assessed based on the specific interest rate. With anything about 10% should warrant aggressive repayment. This approach is primarily called an avalanche method, which mathematically minimizes the total interest payment across all debt portfolio.
That's an interesting thing, right? So is it possible for you to elucidate this if you're talking about an ideal situation? Because I've also heard an argument, Abhishek, in the case of longer loans in particular, that if you are to have a constant EMI, and obviously in that time frame your earning potential and the amount of money that you earn per month should go up. It does go up in most cases, and so therefore you can technically pay more than you are doing in your third and fourth year. But should you invest that excess amount instead of plowing it into your loan, because you could technically, in an equity product, for example, over 5 years, get between 12 and 14% on a conservative basis?
Right. So that is a good argument to have. The important factor is that in any long-term loan, Alex, it is very important that if you prepay the loan in initial, say, second to 5 years, it impacts your overall interest payment over the loan tenure. But because, as you rightly said, people are in their career progression and their income probably would also go over a period of time. So that brings a dilemma whether to try to prepay the loan in the early years or to continue the EMI and then invest the balance in high growth products like you mentioned about equity. So we always have this dilemma, and the way to go about it is to have a mix of both. Try to use your, let's say, irregular payout, like if you receive bonuses or say have kind of a, income coming from different sources at irregular interval. You can use that to prepay the loan to the extent possible, and the balance surplus you can always invest in high growth product, especially when your loan tenure is of say 10 or 20 odd years. That kind of period gives you the flexibility that you can even out the fluctuation which comes with market linked product like equity. So I would suggest, follow the middle path, and that would probably give you both the flexibility as well as, saving interest over a period of time.
The avalanche method, in what scenarios is this beneficial? Would it be beneficial in a home loan scenario? Would it be beneficial in a car loan scenario? Can you elucidate it with a few examples?
Sure. So, I mean, generally, as I spoke about, that depreciating asset like that of a car comes with a higher interest rate loan. So, compared to that of an, say, home loan, I mean, we always advise to start paying the high interest loan, because that way you'll be able to save interest over a period of time much more than, let's say, what you can do with a, that's, I mean, in this case, a home loan. So, start with high interest rate loan. All in all, I mean, I would not even say, if that is the case, if you're in bad debts like credit card, you should start from that, because I mean that those are very outrageous kind of interest rate that is being charged. So start with those loans to begin with, and then go down the list and address loans like I mean, we just spoke about auto loans and such, and then finally try to address, let's say, something like a home loan, which is over a period of 20, 30 odd years. So that kind of approach will probably give you flexibility to
How
manage
does
the
it
payments.
work? How does it work though? If you were to explain
Sure.
how this avalanche, and it sounds incredible, right? So for the, I mean, I'm sure that pretty much everybody has seen an avalanche. It's essentially what happens in snow, where just a pebble can cause the entire mountainside to go down. But how does this work if you were to actually elucidate it?
Yeah, so the idea is that because high interest rate loans would lead to, I mean, if you continue them for a longer period of time, it kind of increases the overall payout throughout the loan tenure. So if you start addressing them first, your overall interest payment throughout the loan tenure on an aggregate basis goes down. So let's say if you compare the interest that you would have paid if you had continued those loans over the same loan tenure compared to trying to prepay the high interest rate loan early on, that would help in saving that overall interest that you would have paid during the same period. So that is how the total interest payment kind of reduces, and that leads to more surplus down the line for you.
That is the avalanche. Okay, I understand that. But then, do you do this on a monthly basis or do you do this on a quarterly basis? Do you accumulate a certain amount of money? Do you invest the surplus and then at strategic moments remove? And also for a mortgage loan, of course, the first 5 years, 7 years are the golden years where
Indeed.
you have a large part of your EMI that goes towards the interest payment. And so removing that principal is significantly more beneficial.
Indeed, that's the right approach, as you rightly said. So start with the, I mean, trying to pay off these loans as early as possible. As I said, if you have irregular income coming in, let's say some bonuses, quarterly bonuses, or half yearly or annual bonuses, those are the kind of, let's say, surpluses which are good to use to prepay the loans, because you're not impacting your overall savings or the, let's say, investment that you're doing. You're not impacting them while creating opportunity to prepay the loan, I mean, through your irregular income. That will help you in reducing the overall interest payment, because as I said, and you also spoke about, the early years in a loan tenure is quite important. The more aggressively you try to prepay the loan in that period, it leads to a lot of money saving over a period of the loan tenure. Perhaps you can use it to, I mean, not reduce your EMI, but you can use it to reduce your overall loan tenure, and that will help you in kind of becoming debt free quite early on in your life.
So there is no one single rule. Therefore, is what I'm getting from it. You shouldn't curtail too much of your savings for the future, but as and when you get a surplus that you were not anticipating or something that does not fit into your regular use, you can use that to prepay. Abhishek,
Right.
in a scenario where the Reserve Bank of India has cut interest rates by 100 basis points, it could cut by another 50 basis points if the expectations are going to pan out. But the question is, if you have the option of reducing your EMI or reducing your tenor, which should you take? Which is more beneficial for you? Should you reduce your EMI, increase your savings, or reduce your tenor and keep the EMI the same?
Right. So as you rightly said, it is quite personal in that regard. So to give an example, when you should choose one over other. So if you're finding your monthly cash flows a kind of a constraint that you're not able to save or balance your budget, then perhaps on a temporary basis you can try reduce your EMI so that it leaves some money on the table to manage those kind of volatile expenses. Whereas if you're in a very comfortable position, you can manage your EMI as well. I would suggest to try and reduce the tenure, because that will kind of give you an option to reduce your overall tenure, loan tenure, and then become debt free as early on as possible. So depends, contextualize and then take an option of that.
Yeah, and you would be spending far less on your interest
Indeed.
payment if you are to reduce your tenor. So if you can afford it, always that might just be the best option. And finally, Abhishek, I ask this question quite often, but I think it bears repeating. In an age where everything is easily available on credit, how much of your monthly take home should go towards EMIs?
In that regard, again, it's quite personal in that sense, depend upon your cash flow situation and such. But as a kind of a thumb rule, good to have around less than 30% of your overall income going towards EMI payment. That will give you comfort in terms of managing your other expenses, because there will be other expenses plus saving required. So, almost a thumb rule of 1/3 of your overall income going towards EMI is a good spot to be. And at a higher level, it can go up to say 40 odd percent, but don't go beyond that is what my advice would be.
Okay.
Especially don't take too much of debt for depreciating assets, because that is kind of, it loses the value immediately, and you end up spending a lot of money on the interest rate payment. So try to pay for those loans using your own savings. So the idea should be that you should stick to these kind of thumb rules and you'll do reasonably well.
Speaking of debt that you shouldn't take, in your opinion, should people take leverage to invest money?
It cuts both ways, Alex, and you are better placed than me in answering that from your experience. So, leverage is something that, if it goes your way, your returns are compounded. But if it doesn't go your way, like you face a situation where there is a market downturn and you're in a position to lose your job or income, it leads to drastic stress situation as well. So the idea is to not to get into that. And try to save money on a regular basis instead of using leverage to compound your return, especially if you're not in a day-to-day basis. You're able to manage the volatility. If you're a long-term investor, continue to stick to regular investment and avoid leverage is what I'll advise.
It's great advice, and thanks so much, Abhishek, for taking the time. Pleasure speaking with you.
Thanks for having me, Alex, and look forward to speaking to you soon.
Absolutely. All right, well, that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in. Let us know what you'd like to hear on this program. We're open to suggestions, and do stay tuned. This is NDTV Profit.